$24.2 billion. That's not a company valuation. That's not a settlement. That's the annual GDP contribution of a single app to the American economy. And in January 2025, that economic engine went dark. But here's what nobody is telling you. This isn't a story about regulation. This is a story about the economics of platform dependency. About 170 million users who built their livelihoods on rented land, and about a $300 billion company that did the math and chose to walk away from America. I'm going to show you the actual court filing where TikTok calculated their economic impact. The numbers will change how you think about platform risk forever. Before we talk about what happened, you need to understand what TikTok actually built in America. This wasn't just an entertainment app. This was an economic ecosystem. 7 million American businesses use TikTok for marketing, not as a nice to have, as their primary customer acquisition channel. 69% of small businesses on TikTok said it was, quote, critical to their existence. That's not engagement. That's dependency. And dependency has a price, but how do we know these numbers are real? Because TikTok had to prove them in federal court. When facing market exit, TikTok commissioned one of the most comprehensive economic impact studies ever done on a social media platform. They needed to show exactly what America would lose. Not opinions, not estimates, verified economic data. And the numbers they presented, they tell a story that Wall Street isn't talking about. Here's the Oxford Economics Report commissioned for TikTok's court defense. This isn't TikTok's marketing. This is independent economic analysis submitted as evidence. Total GDP contribution, $24.2 billion annually. That's larger than the economy of Iceland. Total jobs supported, 224,000 American positions, not TikTok employees. Jobs in the creator economy, small businesses, an advertising industry that depend on TikTok's existence. Tax revenue, $5.3 billion to federal and state governments. This is the economic footprint of one app. Remember this $24.2 billion number. You'll see it again when we calculate who actually loses from this decision. But GDP numbers don't tell the human story. Let's talk about creators. 2 million Americans earn money directly from TikTok, not exposure, actual income. The platform calculated that creators would lose $300 million in the first month alone of a shutdown. $300 million. That's $150 per creator per month average. But averages hide the reality. Top creators earn $1 to $10 million annually. Mid-tier creators earn $50,000 to $150,000. For them, this isn't a platform change. This is a career extinction event. Now let's follow the money to small businesses. TikTok filed in court that small businesses generate $15 billion in annual revenue through the platform. Not advertising spend. Revenue, sales. 39% of TikTok businesses said the platform is, quote, critical to their existence. Not important, critical. Here's the business math. Average customer acquisition cost on TikTok is $2 to $5. On Instagram, $10 to $15. On Google Ads, $20 to $50. TikTok wasn't just cheaper. It was the only affordable option for many small businesses. So why didn't ByteDance just sell TikTok to an American company? This is where the economics get interesting. ByteDance is valued at $300 billion privately. TikTok generates roughly $16 billion in US revenue annually. So selling the US business for $50, $60, even $100 billion should be a good deal, right? Wrong, because TikTok without the algorithm is worthless. The recommendation engine is the product, and international regulations prevent ByteDance from exporting that algorithm. Selling TikTok means selling the interface without the intelligence. That's like selling Netflix without the recommendation system. Nobody wants it. In a moment, I'll show you ByteDance's actual valuation breakdown. You'll see exactly why the math made walking away the better business decision. Let's establish the timeline, because it matters for understanding the business strategy. April 2024, federal legislation passes requiring divestiture. ByteDance has 270 days to sell or face shutdown. December 2024, Federal court upholds the requirement. ByteDance appeals. January 17th, 2025. Federal court rejects appeal. January 19th, 2025. TikTok goes dark for American users. January 20th, 2025. New administration takes office. And this is where it gets economically interesting. Here's what the business analysts are saying. ByteDance didn't miscalculate. They made a strategic decision. Lose $16 billion in US annual revenue. Keep the algorithm. Protect their competitive advantage globally. Think about it. If ByteDance sold TikTok's algorithm to an American competitor, that competitor could deploy it worldwide. Suddenly, ByteDance faces competition in every market from their own technology. The $300 billion valuation is built on algorithm dominance. Protecting that asset was worth more than the entire American market. Here's TikTok's actual court filing detailing their economic harm calculation. This is the document they submitted to federal court arguing against shutdown. Monthly creator losses, $300 million. Monthly small business revenue loss, $1 billion. Monthly advertiser disruption, $500 million. That's $1.8 billion in economic damage every single month. $21.6 billion annually. And here's the number that matters most. They calculated that 7 million American businesses would lose their primary marketing channel overnight. This isn't speculation. This is what TikTok told the court under penalty of perjury. Remember the Oxford Economics study? The 24.2 billion GDP. Now TikTok's own filing, 21.6 billion annual harm. The numbers align. This isn't marketing. This is verified economic impact. Now let's talk about who profits from TikTok's exit. Because in economics, one company's loss is always another company's gain. January 19th, 2025, TikTok goes dark. January 20th, Snap stock up 12% at open. Meta stock up 3.5%. Pinterest up 8%. The market immediately repriced competitors. Wall Street's calculation was simple. 170 million users need somewhere to go. That attention has to flow somewhere. And the companies positioned to capture it saw instant valuation gains. But here's what Wall Street got wrong in those first few days. Creator migration isn't automatic. You can't just move your audience from one platform to another. TikTok's algorithm was the moat. Creators who built million follower accounts did so because TikTok's recommendation engine favored their content. On Instagram Reels, on YouTube Shorts, those same creators start from zero. No guaranteed reach, no algorithmic advantage. The creator economy lesson here is brutal. You don't own your audience. The platform does. You're a tenant, and tenants can be evicted. This pattern isn't new. Remember Vine? 6 seconds. Massive creator ecosystem. Then Twitter shut it down. Overnight, creators lost everything. But TikTok is Vine times 100. The economic footprint is incomparably larger. And the lesson for every creator, every small business, every investor in platform-dependent companies. Regulatory risk is real. Platform risk is real. Building your business on a single platform is building on rented land. The landlord can change the rules or take back the keys entirely. So what does this mean for your portfolio? For your business? For your career? Let's look at the data on platform dependency, because TikTok isn't unique. Every creator economy faces this risk. Every business built on a single platform faces this risk. The only question is when the rules change. And the market data on platform-dependent businesses tells a clear story about how investors should think about this risk. I'm about to show you the data on what happens to creator-dependent businesses after platform changes. The pattern is consistent, and it's not pretty. Here's market data on platform risk from SEC filings and industry research. When Facebook changed its algorithm in 2018, publisher stocks dropped an average of 15%. When YouTube changed monetization rules in 2017, creator-focused companies saw 20% revenue declines. The pattern: platforms control distribution. Distribution controls revenue. Revenue controls survival. For TikTok specifically, Wall Street analysts estimate the creator economy contraction at $4 to $6 billion in the first year. That's $4 to $6 billion in lost creator income, small business revenue, and economic activity. One decision, billions in impact. The Oxford study said 24.2 billion GDP. TikTok's filings said 21.6 billion annual harm. And now market data shows 4 to 6 billion in direct creator economy contraction. The economics are consistent across every source, so here's the investment thesis. If you own Snap, Meta, or Pinterest stock, you got a short-term boost. But long-term, watch for regulation to spread. The same regulatory logic that applied to TikTok could apply to any platform with foreign ownership or data concerns. If you're building a business, diversify your platforms now, not later, not when regulation threatens, now. If you're a creator, same rule. Multiple platforms, multiple revenue streams. Never depend on a single landlord for your entire business. $24.2 billion in GDP, 170 million users, 7 million businesses, 224,000 jobs. Those are the economics of TikTok's American market exit. But this story connects to something bigger, the economics of platform regulation. Next video, we're investigating how regulators calculate the value of breaking up tech monopolies. The FTC's internal math will surprise you. We decode billion-dollar tech economics. If you want to understand how regulation, platforms, and markets intersect, this is the channel. Subscribe.